Well, this week was a lot different than last week. We uh, we topped on the Nasdaq, topped across all equities, which is good. This is what we want to see. This is healthy. We held mid vamp. It's not a crazy sell off. We'll see how tomorrow goes, but today looked pretty strong. Nice healthy pullback, and I think we might consolidate here for a bit. Like it's been quite a run over the last month. I this needs to slow down a bit. Like we're getting pretty far from Momo. Like what are we, like 10% away from Momo right now?
11. Yeah, it's
11%
it's pretty
away.
stretched. Yeah.
So yeah, that's a big stretch. We don't like to see a gap this big between prices and Momo. It's just it sets you up, sets the market up for just a liquidation event, which we do not want to see and we do not want to be a part of. So
Yeah.
yeah, go
Now look,
ahead.
I mean, the market being extended from Momo is not necessarily outright bearish. It just means that things are getting stretched. Now, in a true melt up scenario where all risk is basically being bought with haste, you will see these wide and very stretched conditions where the market or price will drift very quite far from Momo and almost run away from it. I don't think we're necessarily in a melt up at the moment, but I do think that we've been on some very a very rigorous run here the last couple of months. We had a nice pause in the summer, which was I think very healthy, and I don't think it's out of the question that we you know consolidate around here, possibly maybe even at some point drift down to lower vamp. Again, these are the moves that you want to see. Like we saw this in the summer, right? Almost three touches at lower vamp, really building a base. So if we don't make an all-time high soon, we're not scared. It's not a bearish indicator. All it means is, look, the market rallied literally in a 45-degree angle for half a month. It's okay to pull back and consolidate. You should expect this. It's not bearish. It's not the end of the world. We're still positioned. And if anything changes with our positions, our models on the website will update and reflect that move. Until that happens, it is still bullish.
Yeah, I think it's very easy to get caught up in straight up movements, and when that's not happening anymore, people tend to panic. Like you have a little sell off like this and I'm already seeing some people panicking on Twitter. So it's
Oh, I mean, you look,
it's
all-time highs, right? If you're not making all-time highs every day, people get scared. And the reason why people see this, it's a simple psychological indicator, right? In the market. If you're not going up, people start getting concerned that you're going to begin going down, right? So if you're not making all-time highs in the rudimentary view, you're not actually making progress. And what that all that means is people look at the market and they say, okay, no new all-time highs. We're not making progress. We're going sideways. Price action is dead. And that feeling of like momentum and that feeling of like euphoria begins to get absorbed and eroded. And then people begin to get, the concerns begin that, okay, we put in a top. Maybe that was it. Maybe that was the end of the hype train. It's over. And that's where like the concerns start building up. And typically, the way that this really materializes in a melt up is a blow off top where you'll have this huge, immense surge of euphoria into a very short period of time. Price will go up a lot quickly and then it'll fall just as quick. And you'll basically get all these emotions that we're talking about here, like the basing from over the summer where every dip was higher. It was all very structurally sound. Everyone was a bit spooky. It was like, oh, are we going to roll over labor this, unemployment rate? Is it going to start spiking? Fed too far behind the curve, recession. But the market proved structurally to be okay. And it was able to contain that wall of worry and build it up higher. When you have a melt up, you put all of this emotion into a very tight period where you get the run up, the euphoria, and then you get the run down, and everyone's just immediately realizing that, oh, that might be the top, and that mounts very quickly, and people get very scared and accelerates the sell to the downside. And I don't think we've seen that sort of euphoric melt up action in the markets just yet. In at least in the indices, I don't think we've seen a melt up in the indices.
yeah, it's been Well, we just had a conversation about this. Very interesting. How there's kind of like little micro bubbles that are happening under the surface. It's not an overall market bubble, but you have little micro bubbles. Like you've got your Palantirs, you've got your Hood, you've got your quantum stocks, and that's kind of where you're seeing a lot of these people making all their money right now. But then those bubbles are going to burst, and there's going to be a new bubble that forms out of that, and you kind of have these like little bubbles occurring that won't take the market down, but eventually, as that risk appetite continues to grow, I think it's going to start bleeding into the market. And then we get like an
Uh,
overall market bubble. But I don't think we're going to see that unless the Fed really makes a policy mistake and they're way too easy.
yeah, I mean, I do think that we're pretty much forward guidance at least. Maybe not where the Fed is exactly today, but forward guidance is accommodative. So it's easy, it's loose, but it's not overly loose. Now, a good follow up to your point there about the bubbles, and I think we should show this on a graph, is like the best way you can think about this is look at a company like SMCI, right? So let's take SMCI. And what you'll notice here is SMCI was on this major run from 23 to pretty much mid 24, right? Major run. We're talking $11 to $110, and there was a split afterwards, but just a 10x, right? And this 23 to 24 period was such a massive run that you now look at the stock, and there were some fraud charges on this, right? The company had some there was speculation the company committed fraud, or there's bookkeeping errors with the company. There's a lot of issues with the company. This is a poor example as to the meltdown, but think about the melt up here, right? So you saw the beginning phase of this AI bubble, which was all the suppliers and everything, Dell, SMCI. There was a huge run up in price on these stocks. But what happened around like mid 24 is you saw this transition, right? Where like the bubble in began to reinflate in other areas. Like look at Robinhood, right? All of a sudden, mid 24 comes around, Robinhood starts going vertical. And Palantir was already underway at some point, but even then, mid 24, it's like when it really starts taking off. So you almost have like these bubbles that are inflating and deflating within an overall economy that's not necessarily. Is it expensive? Is the stock market expensive? Yes. But is it in a sense in bubble territory? No, I don't think so, at least not yet. So I think that's a dynamic we're going to have to live with for some time if this risk on regime and bull market continues, where you're going to see these themes that will inflate and deflate accordingly within an uptrending market. So, people will look at, again, people will look at some of these stocks and say, Palantir, the Robinhood, and say, oh, look at these stocks. We're obviously in a bubble. Yeah, like those thematic buckets are in a bubble, but there's other thematic buckets that have come off of that bubble pricing. And I think that that's probably what confuses a lot of people and has a lot of people concerned, because you're looking at single names. Obviously, the market as a whole is not cheap, but you're in a situation where you have a risk on regime, positive growth impulses, bullish trends. The market will continue to go up until one of those, if it's growth becoming non-robust or decaying, that being growth impulses rolling over for good, bullish trends breaking down, becoming bearish. These are things that would change the outlook, but we're not seeing that just yet. So we have to stick with what we're seeing, and that, at least on the surface, yields higher prices as it has for the last 6 months or 3 to 4 months.
Yeah. And it's interesting to see that among all of this, Bitcoin is selling off. And we're seeing it in
Yes.
Ethereum now too. It's a little shocking to me because this is as far out on the risk curve as you can get, is Bitcoin and Ethereum. And we
Right.
are
So
out on the risk curve in everything else. There's a huge risk appetite right now. Why is Bitcoin not rising?
so I think that if you believe Bitcoin is a front running asset, right, and it can front run risk regimes to the point where like it picks up on impulses a little bit faster than other parts of the market, given how far out or further out on the risk curve it is compared to like Apple stock. I think if you look at it that way, Since the election, since Trump won the election, Bitcoin is up, I don't know, like 60%. We can roughly chart it out here around that. It's rough estimates, but 60, 70%. And, you look at the NASDAQ from that over that time period since Trump won, right? You go back to November, um, NASDAQ's up 20%. So if you look at it just from a longer term perspective, not so zoomed in, Bitcoin still outperformed most risk assets over the time period of, the last year or so. It's only over the last couple of months where things started getting a bit shaky. And you can argue that growth impulses, so if we take a look at impulses, we went up quite a bit in a month. From August 3rd, we were pretty much at our momentum point in growth, and growth ripped quite a bit in a month. And it's almost at a point where it ripped so fast that there's a good chance that you actually see some sort of consolidation in impulses. Basically, the reacceleration trade in the economy from when Jackson Hole took place, roughly before that, it happened into Jackson Hole and then through Jackson Hole, right? When they solidified the rate cut, going into Jackson Hole, the market actually pulled back on rate cut expectations. There was like a 50% chance the Fed was going to cut rates this month. And then Powell confirmed that they would, basically softly confirmed they would at Jackson Hole. But what the market was telling you was the economy was robust enough it didn't need the rate cut. And that was because internally the market was still robust and somewhat accelerating. At least we saw growth impulses accelerating through the month of August. And we went even further into the month of September. So I think to some degree, the market's been front running a lot of this reacceleration fear that everyone's been so concerned about with the higher unemployment rates. And what this means in layman terms is like all it means is, look, growth impulses are still look they're gonna be okay, but we may have like priced in a lot of expectation or a lot of the future expectations quite quickly, and we might need to take a breather. And we wrote a little ledger about this yesterday, just highlighting that, look, like growth impulses may become softer in the next month or so. It's not necessarily they're going to go bearish, but it just means that there's a window here for consolidation. Get yourself mentally prepared for shorter pullbacks in risk assets. Like, we're now at mid vamp. Yesterday we closed slightly above. We hit mid vamp. In the next month, what happens if we hit lower vamp? At least, maybe lower vamp comes up along the way. But what happens if we dip below today's low? It's not over for the market. It's not cooked. It's not the bear market's begun. It's just, look, you have to mentally be prepared and prepare yourself, mentally be ready for volatility. That's something that we've learned time and time again, being leverage long risk, the market. Basically, we're leveraged long the NASDAQ. And this type of 45-degree angle is cool and fun, but this is not how markets work. They go up and they come down. Like, you're supposed to be the market. Let's just put it this way: the market is not always at all-time highs. It prints an all-time high and it pulls back a bit. If the market was perpetually at all-time highs, you would have a 45-degree angle going up, pretty much. But that's not what happens, right? We know the markets go up, they come down, they consolidate, they go up and down, consolidate, and the waves and ebbs and flows higher. So that's what you have to be prepared for. Look, we had a nice little run there. Could we dip down to the 585 level on the NASDAQ? Yeah, it's possible. These are possibilities. Be prepared for the possibilities. Don't let them surprise you. Make sure you're positioned in a way that if they do come about, you're not up in arms and being liquidated because you decided that the way you wanted to play this was short-dated OTM calls, that you were going to make a run up to all-time highs, and you put a significant amount of your money in it, and they expire worthless. Like, that's a setup for failure. Don't do things that have low probabilities of success.
Yeah, it's well said. And I think Bitcoin it's just gonna consolidate here as well. Like I don't think it's gonna breach below Momo. That would be pretty bad if that happened. I think once
That would be problematic. Yeah, that would
yeah,
be
if
problematic.
if that were to happen, I think it's front running a growth slowdown at that point.
Yeah, I would be a little bit concerned if Bitcoin can't hold this 109 area. Now, I'm not necessarily, we're still long Bitcoin, obviously, right? But like, I'm not necessarily going to get so spooked on equities. Again, Bitcoin has short-term poor relative performance, but it does have good relative outperformance over the last like 12, 9 to 12 months. So maybe Bitcoin's just taking a breather. It's possible, Again, the Fed is, believe it or not, the Fed actually can't, like, look at the 2-year yield, right? The Fed can't get the 2-year yield below 3.5%. This is like their forward guidance, right? Indicator. This is like what forward guidance is implied through, essentially. This is like their policy curve over the next 2 years. We saw that going into FOMC and we snapped back. Basically, what the 2-year yield is telling you is going into FOMC, the market was offsides. The market was too dovish for what the Fed actually delivered. And we're seeing that kind of revert now. So if the run is primarily driven by rate cut expectations, at least initially, and those get taken out, there's a little bit of a pause. But if the economy is robust and does perform, it should be able to pick up the slack and continue with the market continuing higher. But this idea that Powell's going to cut rates, send everything to the moon, that was a little too offsides into the FOMC event, and you're seeing that unwind now with, even things like small caps, right? Like small caps as well, they pretty much peaked into FOMC,
Yeah. Like as soon as the market
right?
realized, oh, they're not just going to blindly cut into strong growth, it started to pull back a little bit.
Yeah, and I mean, like, especially now, like all the Fed speak coming out. Obviously, you have Steve Moran at the Fed now, the replacement, Trump's replacement, who seems to be sandbagging estimates in the sense that he's overly dovish, and this might be just a 40 chess move to basically, become overly dovish and have them meet you in the middle type of thing, right? Be the one on the dots that are weighing down the forward expectations enough that it gives the Fed to cover the cover to cut just moderately, but that moderate amount of cutting would be more than they would have if he wasn't there, bringing down the average or the range, right? Right. If he's in there weighing down the forecasts, and you kind of bring the window down of acceptability, at least marginally, so the Fed can add an extra cut or two that normally would have been seen as more aggressive if you didn't have that sort of dovishness that amplifying those projections. So I think that there's some play there. Should the Fed be at 2% like he's saying? Probably not. I don't think it makes. Most likely not. Doesn't make any sense. But if it allows the Fed cover to cut some more, I think even those intentions would make sense of why he's doing what he's doing, and in turn, risk assets are going to go higher in an environment where the Fed is kind of throwing inflation out the window in turn in fear of labor shocks, and they're just going to let inflation somewhat not run away from us, but be above trend long enough to where the market becomes more of a believer that easy policy is less likely to be derailed, because even if you have a CPI print at 3 or wherever the Fed seems to be putting this shadow baseline in, those are no longer bearish because they're no longer cared for, right? It's almost like an accepted range for the time being. And therefore, CPI holds less and less relevance, and labor becomes more and more relevant. And they'll focus more and more on labor, right? And any sort of labor weakness they'll get very, very squirmish on. And that's where like the market really melts up on, because you're seeing, like, again, jobless claims today, right? You're seeing jobless claims. If we take a look here over the last 3 years, jobless claims, they look like they were breaking out a couple weeks ago. And this is a seasonally adjusted series, obviously. They weren't on the non-seasonally adjusted, but even though so, there was some misprints or whatnot from Texas. Let's just say, they gave some sort of little spooky signal here, manipulate or not, but now we're pretty much at year-to-date lows. So jobless claims are telling you, look, there's no labor stress. This is basically an illusionary shift in the unemployment rate. However this is moving, it's not translating to massive spikes in unemployment claims. And overall, if you look at it on a longer time frame, the unemployment rate, like, let's just go back. The unemployment rate is not necessarily at levels, like, we're still below the lows before the GFC, like the the GFC went underway and the housing market imploded in '08. Like in that run up into the GFC, into that bubble, unemployment today is still lower than where it was when it floored out there before the GFC went underway. So you have to think about, like, is unemployment 4.3% even problematic?
Yeah.
And this is where I kind of go back into my thinking that, like, the Fed is overly they're overly cautious on labor because they're a bunch of economists trained on deflationary economies. They're not ready for this economy. They're not attuned to this current situation.
I think there's kind of like an asymmetrical scenario here where labor shocks, if they're minor labor shocks, it causes the Fed to go too easy, which the market's going to like. I almost feel like the market's going to like some slowing labor as long as inflation doesn't break out. It's inflation that's really going to cause problems if the Fed really has to just hold rates for a long time or maybe even hike rates sooner. That's what would
Well,
really cause shockwaves in the market. But I think like
I th- I
minor
think you're right.
growth, like not even growth, because growth is not slowing. It's just labor. Minor labor slowdowns are actually going to be bullish.
And we saw this happen last summer, right? Like, look at this is what happened for the context. Summer of 2024 rolls around, labor starts slipping. 2 year goes from 4.7 to 3.5 rapidly. Bonds are ripping. This is a deflationary shock. Labor's falling apart now, but we're not really seeing that deflationary shock hit yields. And I think what you're saying here is, like, if the like and to clarify this in chart terms, if the labor shocks aren't material enough and they're almost head fakes, the Fed is going to, you can claim in a very simple view that this area here was over easing by the Fed into this, like, expectations, not necessarily the Fed, but expectations got too easy into the fall of 24 and they snapped back. But you'll notice that they didn't snap back to where they were previously, but they ebbed and flowed. They came down, bounced back, and they rolled over again, coming back. So they're almost ping pong. They are going seemingly lower, but they're not falling apart. So as these labor shocks progress, and depending on the severity of them, I think it's very likely that you see these sorts of slides in expectations. Maybe we even get a little bit lower, and then you get some sort of reacceleration, and that will send yields back up. And you'll do this range where maybe this is the new way we're doing things. Like, we're just basically trending down, something like this, right? Maybe make this trend line a little bit nicer. So we're trending down in this fashion on the 2 year, right? So we're basically going like this. This is the direction. So we go up, maybe come down, we consolidate, we go lower, and we just keep going. Like, we're not falling apart fast enough for a recession, but the Fed is bringing expectations down enough, because of a labor slowdown. Meanwhile, on the other hand, the 10-year, like, this is looking completely different. Like, we're not actually, much, like, we're still higher than where we were in September of 24. Like, remember, I just had the 2 year up. We're actually at those lows. The 10-year is not. And the 10-year looks like it almost seems to have bottomed in FOMC. So this is where the game becomes a bit more complicated. If the Fed keeps doing what you just implied, where they become overly dovish into like the slightest sign of labor market weakness, and the market and the economy actually reaccelerates, stocks are going to love it, because the Fed is essentially bringing policy expectations down, but the economy isn't slowing. So they're essentially loosening policy into a warmer, hot economy.
Yeah, and
And that's only going to,
that's good until it seeps into
it blows the
inflation.
top. Yeah. Yeah. Until either it sleeps into inflation, or what you saw in the dot-com bubble, the economy actually ran so hot that, like, expectations got so rich that they couldn't get any better. That's
Yeah.
what happened. Euphoria hit so hard and expectations were so good. And we're talking, like, massive real output. Like, let's go back to, like, let's see if we can pull a good example here of 2000, 1990 to go 2001. So you take a look at this, right? 1990 to 2001. Give it a second to load. It's a lot of quarters.
I just don't see the Fed falling for it though. Like Powell already kind of stated that the labor, like they're not worried about labor just yet.
Right. But like, look at this, right? So real output was right before the bubble burst. Real output was chugging around 5 to 6% a quarter. Like it was rich.
Yeah.
Like a good example is like, look at where. Let's see where we are right now. Like right now we're at 2%. So we were basically doubling our real output. Like things were rich back then, right? And the economy went over its skis and it burnt out. It burnt out like a star, right? It got so big it burnt out. And I think that if the Fed keeps doing this, they're going to incite those types of animal spirits and those expectations and that accommodation that's going to allow, not saying it's going to happen, but it'll allow an environment for things to get too easy to the point where either you burn out or inflation becomes a problem. The Fed has to acknowledge it, right? If inflation becomes a problem again, like if we take a look at inflation, we're getting up. I mean, we're at 2.9%. If this keeps going, there's signs that like inflation impulses, again, let's go back to our model here. Inflation impulses are just as strong as growth impulses right now.
Yeah, they
So
did
like
pull
it's
back
not
though.
like
And we're not
they
seeing
did they did,
we're
they did
not
pull
seeing
back, yeah.
inflation swaps blowing out. They are
Not
elevated,
yet.
but yeah,
Not yet.
not there is no concern for that just yet. That's
Well,
far
commodities
down the
concern me.
line.
Commodities, at least at this point, concern me a little bit. I don't think they. I think that if we had a real labor scare, the reason why they concern me is um, not because they're actually up. It's that they're up, but we're all expecting like negative effects from a labor scare. The last time we had a labor scare, commodities went down here, right? Commodities went. The GSG went to $19 or $20. It's not doing that now. It's actually going the other way. Yet policy is being set as if we're going to have negative growth impulse implications here, which is, I think, it's a problem. I mean, it's not a problem yet. I'm not I'm not creating a stink about it. I'm just saying, look, You go back to our inflation swaps. Take a look here, right? Where are we right now? Inflation swaps again. Same last summer, they were breaking down. You're not seeing that. So these are like the nuances you have to pay attention to in macro. And it's like, okay, the Fed's talking about labor shocks and possible negative growth impulses from it, right? A recession, like labor creating momentum, a wave of momentum that goes into growth and creates a recession. Well, you're not seeing that. You're actually seeing inflation impulses at the upper end of their range of the last couple of years. So this is not the same type of labor shock the market was pricing in last summer. This is a little bit different. And if this continues and maybe labor rebounds and the economy kind of rebounds, but the Fed's already reduced rates, I think that sets you up for the Fed becoming a bit too easy and therefore putting upward pressure on inflation swaps, growth, risk assets, even Bitcoin. And I think that's like the dilemma we have to work through here. And there's no real like defining factor. Like commodities could, maybe tomorrow there's bad news and commodities start breaking down, they really go down. That would be a good sign. You want commodities down, you want commodities contained. You don't want commodities basing like this and looking like they're going to rip, because if they start ripping, just remember, these are going to feed into inflation swaps. Inflation swaps are going to feed into inflation expectations. And then therefore, it's going to feed into inflation itself. And everyone's going to start being concerned about, oh, the Fed should stop cutting rates completely. But will they? And this is the whole dilemma we have to play out in real time. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.